Well, normally turnaround companies like Vantage Performance work with companies that are in trouble and need to refocus their efforts to get out of a crisis. Now, the crisis is hitting all of us in one way or another, but what we do have is a bit more time to take stock of where we are. That, says Michael Fingland, means this is the right time for every company to have a good hard look at themselves. That's what we discussed today on the Vantage Performance podcast. So this is a challenging time, isn't it, for all of us, Michael? And I guess the focus for a lot of people is just how do we get back to where we were, but which is not necessarily the place you want to be. Now we've got this time, the opportunity to refocus. We should be looking at, how different do we want our company to be when we are back trading full time, so that we get that competitive edge.
Yeah, exactly right, Phil. I mean, any recession or black swan event that we're going through now requires some pretty big questions to be asked to ensure that your organization can actually get through what is a massive disruption event. And identifying those 1 to 2 really big changes in strategy, your business model is one of our core models to the way we look at turnarounds. And it's forcing a lot of companies to ask that question right now.
But I mean, the other question everyone's asking is, what's it going to be like after this? So, and we don't know for sure, do we? So I guess it's a question of managing risk, isn't it? Because, there's 1 or 2 potential possible futures at the end of this.
Yeah, and it is difficult, and it's always difficult with any deep recession to know when we'll sort of bottom out. Will it be it's very popular at the moment, is it going to be a V shape or a W shape or a U shape, L shape? Who knows, right? We can all have our opinions, but
let's hope it's not an L. An L shape is the most depressing scenario. So let's assume there's some sort of upward curve on all of this. But it is a question, isn't it? Is it going to be over in 6 months, or is it going to be over in 3 years?
That's right. But I think the key to this is to ensure that all of the restructuring that you're doing right now is going to be conducive or result in a business and a business model that is the most flexible it can be, so you can adapt as we go through this. Because as we've talked about before, no turnaround and no recession is ever a straight line. It's always bumpy. You always have some shocks along the way. So you need to have a plan that's going to adapt to that and have a very nimble business to ensure that you can survive through this next process and then grow on the back.
Do you think there's a danger, though, that lots of companies are thinking, how do we get through this? How do we get through this 6 months or this year without thinking about doing something different at the end of it? Sort of like, how do we get through so we can get back to the way things were?
Absolutely. I mean, and that's why we always recommend, the first phase should always be stabilization, because you need that clear air. You need that stability, so you then have time. And it's always typically a 100-day plan, as we've talked about. But then you've got some free time. You're still going through crisis, don't get me wrong, but you've got a bit more time to be able to think big picture, think more laterally, bring in third parties who have the ability to without any clutter to really help you cut through, to work out what any other stabilization measures you might have, but what are those 1 to 2 big changes that form the bedrock of the plan going forward. And we'll talk through today, some examples of some big name companies who have done exactly that. They've identified those 1 to 2 or 3 big changes, and they've built their turnaround plan around that. But you can't do that until you've stabilised the business. So hopefully, most businesses over the last 3 months have done that, and now's the time, if they haven't yet, to really fundamentally look at their business model and ask that question: what are they, and will that result in a business that is really nimble, so I can adapt and flex as we go through?
Right, which sounds easier said than done, though, because that stabilisation process where you could be losing all your cash flow, depending on what industry you're in. I mean, there's some industries which have been absolutely decimated by this. How do they stabilise if there's no money coming in?
I mean, there's been a lot of government stimulus packages rolled out, and all the usual typical stabilisation measures, renegotiating terms of trade with key creditors, tapping into the support packages the banks are offering, negotiating statutory payment plans. There are a lot of measures you can do, and the JobKeeper program in Australia particularly has been, in other countries, New Zealand, UK have done something similar. They've given most businesses the ability to get through the first 3 to 6 months, but don't lose this opportunity, and let's think about what are those big changes. But you'll probably need someone external to help you, because most business leaders will still have a fairly fuzzy head because they've been knocked about so much, and it'll be difficult for them to see clearly what those big changes might be.
Well, okay. So you said you wanted to give examples. So which companies which big name companies are doing this, and are doing it in a very clear way?
Yeah, I mean, we'll run through some examples, but some of the key questions to arrive at that is, what are we really, really, really good at? Because a lot of businesses get a bit lost along the way as they grow. Their core why, their purpose gets a bit fuzzy. What is that key element of the business model that made them really successful, and has it got a bit lost along the way? Have you added too many things along the way?
Back to basics, really.
It is back to basics, and it sounds a bit flippant, but at least 50% of all turnarounds, if not more, result in the company actually shedding a lot of products or services that have just been added on for growth's sake, but they're not generating profit. They're sucking up a lot of working capital. They're cumbersome. You've ended up with a massive overhead structure to try and manage all these additional services and products. So often the key to a turnaround, and particularly in this current time, because if you do shed a lot of products or services, whatever, it's actually going to free up a lot of working capital, which could give you an extra 3 to 6 months, right, or more. So that's often one of the big solutions. And it's going back to what did you look like? Another key question. What did you look like when you were the most profitable? It sounds a simple question, but it can be really powerful. I mean, you look at Apple, right? Even since Steve Jobs died, it's gone from sort of $50 to $350 a share. So it's done incredibly well even after he died. But I'm talking about the period where Steve Jobs came back into Apple. I mean, it was very close to bankruptcy, right? And what did he do? He got rid of 80% of all their products. Okay, number one thing he did, got rid of 80% of all their products. And he came down to just 2 laptops, 2 desktops, right? They had a plethora of products, mediocre products, Me Too products, and so he stripped it all back. So all the R&D was then channeled into reinvigorating that core product range. And then as we know over the years, all the other industry, worldwide sort of disruptive products that came off the back of it.
Well, it gave him focus, gave him the ability, didn't he, to focus then on the next big thing.
And he didn't just do one, he did a few big changes. So rationalised the product range. Obviously, Apple at the time was struggling. It didn't have a really good operating system. So with Jobs came the next operating system. So they made an acquisition, right? That could be one of the two big changes in your strategies. Do you make an acquisition? And if it makes sense, you'll get the capital to fund it. So don't think, how are we going to fund this acquisition? So they made an acquisition, which gave them a critical edge in the market, rationalised his product range, and Bill Gates, Microsoft, invested into Apple, 2 arch enemies at the time, $100 million investment. So that is a big change in strategy. A competitor who's got a vested long-term interest in Apple surviving, and that's why Gates clearly did it. He knew that Apple surviving is going to be better for Microsoft in the long run. And then he through that process, he repositioned Apple to be a high-end brand, where now people happily pay $300, $400 more for an iPhone than other products on the market because of the brand and everything that goes with it. And he reopened stores at the time. There was a whole move to online. He reintroduced the concept of flagship stores, totally against the market. So he had sort of 3 or 4 big changes, and we know what's happened since.
And it all came from that rationalising and getting rid of the dead weight so you could focus on the future.
Focus on what you're best at.
Yeah, exactly. And yet, BP, let's look at them as an interesting example, because they're undergoing a lot of change. Maybe not focusing at what they're best at, because I guess they're an energy supplier, but they really are focusing between now and 2050 on moving to rely less on oil and petroleum, which of course is in their name. It's where they came from. I mean, they're assuming now that the price of oil isn't going to rise. I think it's $50. They're saying now they've downgraded their forecasts of the price of oil by 25% between now and 2050. So it's a big slug of revenue that they're basically writing off. A whole load of assets they've written off based on mineral extraction. And they're looking more at renewables. That's a huge shift in emphasis.
Yeah, I mean, and energy-rich industries, we're heading towards a massive disruption event anyway. So I think this period is just going to fast-track that. As you say, BP is one example where they're going to have to pivot and move to more renewable energies. And that's, you're going to see that. And new business models have come up over the last few years to tap into that, such as Tesla and others. And you look at Starbucks. I mean, Starbucks, And a lot of these situations, they do end up in rationalising their cost base, right? But it comes off the back of, and unfortunately that does mean job losses in many cases, but it comes off the back of what is that streamlined business model. And getting back to what they were best at, Starbucks became lost along the way. Their brand became very me too. The coffee wasn't great anymore. So, and Howard Schultz, who again came back into the frame as the CEO, realised that the level of training and skill across their entire 11,000 stores was nowhere near what it used to be. So he actually shut all 11,000 stores in North America and got all of and it cost them $33 million, right, to get every single store manager. He realised a store manager was the key. And they took the entire organisation through a retraining program, but he shut all 11,000 stores and got them all into one central location and gave them a huge sort of, this is our why, this is our purpose, this is what we've got to get back to, and retrained all their baristas and got back to the core central focus is we are great at coffee. Let's stop mucking around with all these other products and services we're trying to sell and get back to that customer experience. And, so that was a really big, bold move. And we've seen it with Qantas, years gone by, where they grounded the entire fleet to try and force some change for the organisation. So, you do need to be bold, you do need to be courageous. And now is the time, because if you just focus on how we're going to get through the next 3-6 months, you are not going to utilise this opportunity where others are, and they will come out of this stronger, more nimble, and will take advantage and take market share.
Yeah, well, it's interesting you mentioned Tesla, which has now got a bigger market cap than Toyota, which has taken, goodness knows how long to reach the stage there. And here comes a newcomer, and it's bigger than they are now. And you look at, at times of adversity, how many companies, successful companies, brand names that have become very established, actually came out of an economic downturn, I guess, because they didn't have the legacy that was holding them back. They could start afresh, go after a market when the economy recovered. And you're sort of talking about the same thing, aren't you? You may not be a new company, but you can still get rid of a lot of that legacy, so you can behave like a new company. Exactly right.
As I said before, how do you restructure your cost base so you're very nimble? A lot of companies have that went on to become incredibly successful, started in a recession because you've got that lean operating base from day one. Whereas other competitors that you might be up against still have that clunky, heavy, heavy cost to restructure sort of business model. And there's many case studies around this as to why a lot of automotive companies will not make the switch or will not survive the switch to electric, because invariably companies in certain industries that are going through massive disruptive events do not make the jump. So very, very early on, obviously companies would cut block ice. This is going back, 150 years or so. You would cut block ice, in the winter time, cut it up, distribute that to your client base. Obviously your range was very, very narrow because you could only cut it so far. Moving on, decades later, you then had big ice factories. Now, not one regional ice carving company, if you like, made the transition to an ice factory. And then the next evolution came when fridges and freezers came along. Not one ice factory ever made the transition to become a refrigeration company, because they don't see the big disruption coming. They don't look at those 1 to 2 big changes. And the sunk cost of all the tooling just makes it very difficult for them to be nimble and move and follow the innovation curve. And you're seeing that with automotive companies. They have resisted the move to electric cars for decades because a lot of the tooling they've got to make a combustion car is irrelevant, is redundant as they move to electric. So you can see it happening real time now. How many of the 30-odd car manufacturers are going to survive this switch to electric? And probably half at most, because you're going to your shareholder base to say we've got to write off $5 billion of plant and equipment to make that transition. That is highly problematic. But if you don't start early,
the alternative is worse.
And Tesla started very nimble, very all these new entrants. Very nimble business models.
So you're saying then that, because there's two things going on here, isn't there? One is that we have an economic downturn which is impacting every business, and so how do you use this time, and how do you come out the other side as a lean organisation that's more focused on what you're good at, as you described it. But there's also a question of, what's the future going to look like as well? What is going to change? Are we going to go back to exactly the way things were, or is the market going to be very different? If you look at those two together, then every business surely has to be going through this process. It's not,
absolutely.
I mean, normally you would be dealing with companies that are struggling, going through a difficult time, but this is something for everyone to look at.
Everybody should be looking at, how do we become more nimble? What are those you might already be focusing on those 1 to 2 big core parts of your business model, and that's fantastic. But still be thinking, how can we be more nimble? How can we be more adaptive? No one knows exactly where the industry or the economy is going to be in 3, 6, 12 months, 2 years, right? So, that's not the point. The point is to have a business model that can be very adaptive and very flexible. And it's a core bedrock of our turnaround model. It's a key part of why we've had a 90% success rate over the years, is because only 5%, maybe 10 at best, businesses will have the foresight to be really focusing on those 1 to 2 big changes, and that's so critical. Use this time now to really identify that, build a plan around that, because you're more likely to be able to attract capital as well if you can demonstrate that the pivot, a switch to really focus on those core areas, is going to drive top line, gross margin, profit, loss, whatever, and a greater working capital profile, greater operating cash flow. And standing out from the crowd is going to be so difficult. So, because bankers are going to have to choose winners and losers. It's a very simple fact. There will be a credit crunch. So if you do need to access capital, you need to present yourself in a way that's exciting, it's attractive, and you can see that a pivot in your business model is going to generate, a much more profitable, sustainable business.
Okay, that word exciting is interesting, isn't it? You've got to get yourself excited about your business again so you can sell it to everybody else. Yep. A huge opportunity. Great to talk as always. Makes a lot of sense. Thanks, Michael.
Cheers, Phil.
And if you are asking for investors or your bank for more money, then they're not going to bail you out, are they, if they don't see you coming out stronger? So you have to have a workable plan. You've got no choice in this, really. That's it for today. Thank you for listening to another edition of the Vantage Performance Podcast. I'm Phil Dobbie, back again with another one with Michael Fingland next time. Thanks for listening.